So, let's talk about something really weird that happened in the world of private credit. A company called Blue Owl came out with what looked like amazing news, but the market completely freaked out, like it was the worst thing they'd ever heard. It makes no sense, right? Well, let's get into it.
And that's really the big question we're tackling here. How on earth does a move that's supposed to show everyone how strong you are, how solid your assets are, end up causing a total meltdown in your stock price? It's a puzzle that really gets to the heart of how markets and human psychology actually work. And here it is, laid out plain and simple. On one side, the good news. Blue Owl sells a huge $1.4 billion loan portfolio for basically full price. That should scream quality. But then you look at the other side, and the company's stock just got absolutely hammered. The two just don't line up. So, what was really going on? To solve this mystery, we've got to dig into the deal itself. You know, the one that was meant to be this big, reassuring signal to investors, but ended up lighting a match instead.
First off, let's just appreciate the size of this thing. We're not talking about a small garage sale of leftover assets. This was a $1.4 billion deal. Blue Owl shifted a massive piece of its portfolio over to other big-time institutional investors.
And here's the part that should have made everyone cheer: the price. They got 99.7 cents on the dollar. I mean, think about that for a second. These aren't amateur buyers, they're sophisticated investors who do their homework. And they looked at these loans and said, yep, these are worth pretty much exactly what Blue Owl says they are. That is a massive vote of confidence, right?
So the signal Blue Owl was trying to send couldn't have been clearer. Hey everyone, look, our loans are top-notch, and here's proof. That really should have been the end of the story. But it wasn't. Because there was a catch, a detail hidden in the fine print that changed everything.
And this is where we get to the real heart of the issue. The market's panic wasn't really about the loans they sold. It was about how they sold them and a little policy change they announced right alongside the sale.
Okay, before we go any further, there's a really important concept we need to nail down: illiquid assets. See, private credit loans are illiquid. You can't just click a button and sell them in a microsecond like a stock. It's way more like selling a house. You got to find a buyer, you got to negotiate, it takes time. And that's a fundamental challenge in this whole space.
And the other key word you need to know is redemptions. It's just a fancy way of saying investors want their money back. And when you have a whole bunch of investors asking for their cash back at the same time from a fund that's full of those illiquid assets, well, you can start to see how a problem might brew.
And boom, here it is. This was the catch. At the same time they announced this great sale, Blue Owl also changed the rules of the game. Before, investors could ask for some money back each quarter if they wanted to. The new rule? Nope, can't do that anymore. From now on, you'll get cash back only when Blue Owl decides to sell assets and distributes the proceeds. To the market, this felt a lot like someone slamming the emergency exit shut.
So this one move created two totally different narratives. Was Blue Owl actually helping investors by getting them cash faster? Or were they trapping them inside a fund that was starting to feel shaky?
Okay, first let's hear Blue Owl's side. Their co-president, Craig Packer, basically said, whoa, everyone calm down. We're not stopping you from getting your money. We're just changing how you get it. He argued that this new way was actually faster, that it was accelerating payouts, not halting them.
But that is not what the market heard. Not at all. As analyst Brian Finneran points out, the optics, they were just awful. The story the market told itself was that a stampede of investors was heading for the exits, and Blue Owl had to sell off their good stuff and change the rules just to stop a full-blown bank run.
And this is where the story gets so much bigger than just Blue Owl. The fear wasn't just about this one company. The real fear was, is this the first little tremor before a massive earthquake hits the entire private credit industry? Is this the canary in the coal mine?
And that fear, it had very real consequences. Just look at the stock price. It was already having a tough time, but after this, it went into a complete freefall. The market voted with its wallets, and the decision was brutal. More than half of the company's value gone in a year.
What really poured gasoline on the fire is that this whole situation gave people serious flashbacks to 2007. The famous economist Mohamed El-Erian even asked out loud if this was a canary in the coal mine moment. A direct comparison to the collapse of two Bear Stearns funds, which was one of the first big warning signs of the global financial crisis. Just hearing that comparison is enough to start a panic. And something else was making investors nervous. It was the fact that Blue Owl had so many of its eggs in one basket.
70% of its loans are to software companies. Now, in a market that's already jittery about a tech slowdown, that kind of concentration looks less like a smart bet and more like a massive risk.
When you put it all together, what this story really teaches us is how fear itself can become the problem. It's a classic case of a self-fulfilling prophecy, where the fear of something bad happening actually makes the bad thing happen.
And here's exactly how that vicious cycle works. Let's walk through it. It starts with market fear, which triggers investors to want their money back. Step 2, that forces the firm to sell assets to get cash. But then, step 3, the market sees that asset sale and says, "See? I knew they were in trouble," which confirms their fears. And that leads to step 4. The stock price falls even more, which creates even more fear, and the whole dangerous cycle just feeds on itself.
So if you take one thing away from this whole blue owl mess, it's this fundamental clash right here. You've got funds built on long-term, illiquid assets that are hard to sell. But you've got investors who might want their money back on short notice. And when confidence gets shaken, that mismatch can be absolutely explosive.
Which leaves us with one final, pretty unsettling thought. Blue Owl says its loans are solid and their move was good for investors. The market is convinced they're in deep trouble. So, in a nervous market that runs on pure belief and confidence, does the objective truth even matter if everyone is convinced the worst-case scenario is already happening?